Welcome everyone to our fifth web event for 2020. This one's titled Markets and Economic Implications of the Election. We very much appreciate everybody spending their time with us for the next hour or so as we discuss the economic effect of recent and still ongoing elections and what impacts we believe that they'll have on markets. We also want to recognize some special guests that we have today from the Chattanooga State Planning Council. I'd like to thank you guys for joining us, and also thank you for your interest in our event today. For those of you that don't know, my name is David Babb. I'm a principal and co-founder of Stonebridge Asset Management. Eric Bohm and I started Stonebridge in 2011. As an independent registered investment advisory firm, we manage assets and create and implement actionable financial plans for individuals, businesses, endowments, and trusts. Also from Stonebridge with us, we have Tom Francescan, who is a relationship manager and a SmartVestor Pro advisor, as well as Joseph Davis, who's trading and research, and also Samuel Hong, who is our planning liaison. Again, just some quick housekeeping. I put in, if you're not familiar with Zoom, you've got kind of a box down below, like if you bring your cursor down below on Zoom, you see a couple different icons. In the chat icon, for those of you that want to get your CE credit for today's event, I've got some information in there for you. You're going to send an email to Robin Holcomb at reh@smrw.com. Mention the phrase or put in your remarks thankful20 so that they'll know you attended the event, and that'll get you your continuing ed. Also, I'm going to try my best to keep everybody on mute. Use the chat box. If you've got questions as this event goes on, use the chat box, and we'll do our very, very best to get to everybody's questions. We're on a pretty tight time frame today, so if we don't get to everything, we'll make sure that we get responses back to your questions either through an email or another broad we can do. So with that said, let's get right to it. You know, today we're very, very fortunate to have David Coe and Brad Pineault with us from Fidelity. Some of you that have been part of some of our other webcasts, you may remember David. He was with us earlier this year as we discussed biotech and viruses. He's back again with Brad as we dive into the most recent events of the election and what that might mean for our clients in the near and long term in their portfolios. With that, turn it over to you, Dave. Take it away.
All right. Well, David, appreciate that kind introduction. And of course, we here at Fidelity appreciate the partnership that we have with your business at Stonebridge, on the custody side, as well as investments. So it's my pleasure to introduce Brad Pineault from our capital markets team here at Fidelity. He serves as a liaison from our chief economists and various asset allocation teams to really help inform our institutional clients and investors such as yourselves on kind of the best in class thinking from Fidelity and how to make sense of the broader macro economy and apply it to investable ideas and how to think about the months, quarters, and years ahead in light of this new administration. So without further ado, I'll kick it over to Brad for an update on what we could expect to see in terms of policy change, et cetera, from the recent elections. So Brad, over to you.
All right, sounds great. Well, thank you, David and David. Really happy to be here, to say the least. I'm coming to you from Massachusetts, where we've had a string of weather, almost a weekend of 70 degrees and nothing but sunshine. Not sure what's happening, but I'm not going to rock the boat. It's been an interesting year, not just weather-wise, but as we know, 2020 will have a few asterisks next to it in the history books. We certainly had a presidential election, although the dust seems to be settling on that topic. We've had a global pandemic, and I wish I could say it's past tense, but it's certainly very present. We can reflect a little bit on that. And we've had an economy that had one of the deepest recessions in the history of the world, but it was also the most ephemeral. The recession is now over. It's been over for a while, actually. But again, deepest yet shortest, the distinction on both sides there. The stock market continues to do well. We're seeing a little bit of a change in leadership here over the past week, 2, 3. But, really the market continues to remain fairly healthy in terms of its fundamentals. It's a good thing we could say that. And the market's up 10% year to date. And if you're doing a little bit more tracking from the bottom on March 23rd, depending on what you've owned, you've made a lot of money this year in spite of all the uncertainty. So what I'm really going to reflect on here is a few things. We're certainly going to talk about the election, not so much the election itself, but post-election. We're also going to discuss the economy, right, and how it's been recovering and what the pathway is going forward. And then lastly, we'll reflect just a bit on the portfolios, right, what we feel like would be a good investment based on policies that could play out here in the next 12 to 24 months. So with that being said, I will get into Q&A. In fact, I'd encourage it. I do this about 12 times a day, and I do a lot of talking on my own. So anyway, it's just part of the job, I suppose. But a dialogue is always much more preferred than a monologue. So if you're thinking of questions, please feel free. We can get right into it. So again, as we look here at the dust settling on the election, it does at least appear apparent that Joe Biden will be the 46th president of the United States. And of course, the Senate is a bit in flux with the 2 runoffs in Georgia. So David will be doing his very best, David Coe, that is, out of Atlanta. So represent as well down there, David. But we do have 2 special elections. As you know, I won't go too deep there, but if you have questions, certainly. But this is how this will play out as far as the broader market. You're either going to have a GOP-led Senate, even if it's 51-49, you're still going to be led by Mitch McConnell, or you're not, right? You're either going to have that or a 50-50 Senate. At best, the Democrats can only get 50 seats, at least into the midterms. Now, a 50-50 Senate, in effect, is going to be a Democrat Senate because the White House will be Democrat. And we know the vice president, just to make sure we're all on the same page, would provide any tiebreaker, if need be, in a 50-50 tie for any legislation. But consider this. It's our opinion, a lot of this stuff is a hypothesis, of course, but it's our opinion that in a Republican-led Senate, taxes would most likely not go up, right? Not even for the wealthy, not for corporations, none of it, because Mitch McConnell just won't see to that, right? I mean, they're not going to vote on something that they have no interest in. So taxes most likely don't go up. But what also doesn't go up in a GOP Senate is the probability of significant government spending. So it's kind of a catch-22, right? No higher taxes, but also no significant government stimulus. So that's something to ponder and reflect on, and we'll get back to that here in a moment. A 50-50 Senate, as I mentioned, that's basically, even though Chuck Schumer won't be effectively the Senate majority lead, the president of the Senate will be Vice President Harris. This is just semantics. But the way we look at it is there are greater chances for more tax increases and additional government stimulus. But let us not kid ourselves. In a 50-50 Senate, everything needs to go right for the Democrats. You can't have one dissenting vote, at least that's the idea, for some of this significant legislation. And the Democratic Party coming into this election, at least over the last several weeks, maybe even several months, they were really espousing some very progressive policies, right? Really big spending programs, $4-5 trillion, a $2 trillion tax hike, perhaps progressive cabinet picks, right? And you could all, think about who those might have been. Not to say those can't happen, but there are plenty of centrist Democrats who'd rather not see that happen. You think of a Christopher Coons out of Delaware. He's a Democratic senator, but he sometimes thinks like a Republican, right? Can you believe it? If you think of Joe Manchin out of West Virginia, again, a Democratic senator, long-term senator of West Virginia, but he typically doesn't like to see big spending programs. So we just thought that he may not have been in favor of that. So in a 50-50, you can't have any of that. So the legislative programs that the Biden administration probably would like to see, even in a 50-50 Senate, may not become an actual reality here. The reason why this makes sense for money and portfolios is that the scales, the two extreme events have really been truncated here. And gridlock can be very good for economic growth and certainly for the financial market. There's less uncertainty in this environment. Now, what I find fairly interesting, actually fascinating really, is the fact that with a Democrat in the White House, and if the Republicans keep their lead in the Senate and the House under Speaker Pelosi, we haven't had this set of partisan politics since Grover Cleveland's second term in 1888. You really can't make this stuff up. So it's been a long time. And typically, if one party wins the White House, their party takes the Senate. It just happens. In fact, we haven't seen this since '88 when Bush won and the Democrats kept the Senate. But nonetheless, I don't want to digress about historical presidential politics. The other component I would just suggest is that a 50-50 Senate is an exceptional rarity in U.S. politics. The last time we've seen it was 2001. That was when Jim Jeffords, the Republican senator from Vermont, defected to the Democratic Party. He just wasn't jiving with George W. And of course, that lasted for 10 months. You had a 50-50 Senate until the Republicans picked up a few seats in the 2002 midterms. Prior to that, you have to go back to Ulysses S. Grant, 1871, last time we saw a 50-50 Senate. So it just doesn't happen. And I would suspect, even if it does, 2022 is just around the corner. So those are the two observations. And one other one, you're probably aware of this, but Joe Biden and Mitch McConnell are no stranger to each other. In fact, when Joe Biden was vice president in 2010, 11, 12, it was the Senate Minority Leader, Mitch McConnell, who was the prime negotiator with the vice president to overcome two fiscal cliffs and a debt ceiling issue. That's a real big deal. So when you think about Biden and McConnell, if that's how that plays out, I've heard plenty of pundits say that nothing will get done in Washington for 2 straight years, and I'm just not there. I feel like you're going to have plenty of things done, but it will just be a bit more pragmatic and certainly a bit more measured, which the stock market is going to love. That's, again, a hypothesis, but that's how we're thinking of it. Now, a gridlock Congress is good for stocks, but not if you have a global pandemic that just won't go away. And of course, what I mean by that is this needs to be addressed, right? It's not just going to evaporate, but there's really 2 stories to be told around COVID-19. And I'm going to share with you very briefly the 2 sides of the story. First and foremost, the optics around COVID-19 have never looked worse, right, in terms of new daily cases globally and certainly here in the United States. However, I didn't want to show you a chart that just focuses in on cases, because the cases would be up here, right, kind of in the northeastern quadrant, and it would look pretty bad. The media does enough of that, so I figured I'd take the different approach and show you that, yes, while cases continue to increase, in some cases precipitously, so do the tests. Right? And that's a big part of the story, that in the United States, we're testing nearly 1.6 million people per day. That's twice the number of people that we were testing pretty much on average back when cases were increasing in the summer months. And as you can see, we were doing basically no testing in the spring, about 200,000 per day. So call it 8 times what we were doing in the spring. That's where we're at today. The cases might seem pretty ugly, but they're not all that much higher than what we had in the spring, in the summer. And you can see the positivity rate is the resultant quotient here, right? So number of positives over number of tests, you're at the same positivity rate that we were at back in the summer. And I don't have the chart here, but hospitals do remain open for business, right? There's obviously a lot of misleading information. And when you throw a healthy dose of fear into it, we just feel like things are going to get a bit interesting. So that's the challenging narrative around COVID-19. It certainly still remains with us, and it remains highly relevant. And we're not out of the woods as of yet. However, there are a checklist, right? Whether it's a mental checklist or whether it's just something we should look at. Now, if you look at this wheel, this to us is the element wheel of how we can live better with COVID-19, right? Globally, domestically, in your own state. And this is how we're thinking of things. we're doing more testing, right? We obviously have more progress in treatment, whether it's antibody cocktails, whether it's other types of therapeutics, right? These things are real and they are working. They kind of get lost in translation, but the Gilead drug, the Eli Lilly drug, the Regeneron drug, these companies continue to, I would say, make some incremental and measurable strides and success here. We also know that if you think about one of these checklist items, a vaccine would be great, wouldn't it? Now, we don't have an approved vaccine as of yet, but as you know, we are closer and closer, especially with the news of yesterday at 5 a.m. Eastern Time. Pfizer and their partner BioNTech out of Germany released very favorable phase 3 trial data in terms of the efficacy, and we believe the safety effects of their vaccine. And I'll tell you, folks, we've been talking about this COVID situation really since February. And when it became apparent that we were going to lock down and people were wondering what the most effective pathway forward was, we were suggesting that it's only a matter of time until we have a cure, right? An inoculation, a vaccine. And in every sense of that phrase, it's only a matter of time, right? It's not as if we're not going to have it. Just pick your time frame. Well, now, an efficacious vaccine that will eventually become a commercially viable reality is a near-term, right, option. And I will also say this as humbly as I certainly can. The vaccine from Pfizer will be one of many vaccines from other companies, right? So we will have a plurality of vaccines. And while the timeline for manufacturing and distribution of the vaccine is still uncertain, to us, if we want to be conservative, it's probably a summertime event when somebody on this call or this video wants to consume said vaccine, you will have the opportunity to do so. It might even be sooner. We know that this particular vaccine, the mRNA aspect of it, makes it very challenging to store. It has to be stored at negative 82 degrees Celsius, which is 112 degrees Fahrenheit. Your household freezer is not going to cut it. So that's going to be a hurdle, but doesn't mean that it's not going to happen, right? It's just going to be a challenge to actually do this. UPS and FedEx, for what it's worth, they've already invested in these freezer farms. You might have read about that outside of Louisville and the Netherlands. They're two global hubs. As well as Memphis, so certainly FedEx down that way. So those freezer farms are basically being manufactured for that very reason, and DHL is also doing the same thing. So again, this is a very significant step in the COVID situation, and we believe that even if we get significant lockdowns here, the lockdowns will prove very short term and they won't have nearly the adverse implications as they did back in the spring. So that bodes well for the future growth of the economy. Folks, while we wait for a full-blown vaccine, we know that fiscal stimulus is the political volleyball, right, that we keep hearing about. And as you know, the Democrats would like a big splashy couple $1 trillion, almost like the CARES Act Part 2. And the Republicans, at least publicly, have said they really have no interest in that. They'd like something closer to $1 trillion. At least that's the last time I've checked in on that. So 2 trillion, 1 trillion, to us, we don't think 2 trillion is needed, especially as the economy continues to improve here and with the vaccine news. But at the same time, it's not like we're not going to get stimulus, right? I'm sure a lot of us would agree that in order for the economy to continue to grow and people to get their jobs back and people to spend money and companies to make money, we'd like that to be more organic than government sponsored, right? I think a lot of us could agree upon that. It's one thing for a household to get money from the federal government to allow them to, at least put food on the table. It's another thing for them to actually work, and earn that. And we feel like the latter is a much better outcome long term. But we can't do that without a vaccine, right? Social distancing is obviously a hamstringing event. So what I will tell you, though, is even though we've been dealing with this pandemic, perhaps a silver lining in this whole thing is the fact that the government has been exceptionally munificent in their policies around lending and spending. And of course, that's code for they've been very generous with Fed policy, monetary policy, and of course, the congressional actions on behalf of the CARES Act back in late March. Between the two of those, we're basically looking at about $6 trillion. Let us not forget our GDP to keep the number simple, $20 trillion. So 6 trillion of 20, that's 30% of our GDP has been allocated on behalf of the US federal government to ensure that A, we don't go into a financial crisis, and B, we provide an income bridge, right, until we have no more pandemic. So far, so good. They've both been very successful. And of course, the kicker in all of this is what I just mentioned about our economy here. It's happening globally, right? Every major economy in the world has generated more monetary and fiscal policies. And as a direct result of all that, look at these color-coded bubbles. These bubbles represent where the economies are in the different distinct phases of the economic cycle. Now, I'll stay very high level in terms of Econ 101, but we know that major economies, even developing economies, go through this evolution of 4 distinct phases of macro growth. Early, mid, late, those are all growth areas of an economy. And then there's a recession, which is obviously an outright contraction. The good news with the recession is it's typically the shortest of the 4 phases, right? Thank goodness. But that's usually because policy dictates how long you're in a recession. And case in point, this year we were in a recession for all of 3 months. Again, as I mentioned, the shortest on record. It was very deep, but that's because we're out of that globally because of the outstanding, extraordinary, unprecedented amount of policy. So if you look at these bubbles, 85% of the world's GDP, Japan's about to go for the ride here. Next quarter, they should be in a recovery mode just based on their GDP. But 85% of the world's economy is now growing and growing precipitously. Now, the absolute levels matter less. What I'm basically saying is nothing to see here that 7 million people still don't have a job, but it's not 25 million people, right? So relativity matters for everything when you're thinking about these different phases of the cycle. And you can see that right here, right? Activity has certainly rebound. Another way to think of it is GDP was down 32% in the second quarter. It was up 33% in the third quarter. Year over year, GDP is still down, but from a quarter-over-quarter basis, right, things couldn't be better. And that's really important because in an early cycle environment, regardless of the election outcome, frankly, right, and in fact, I actually feel like the early cycle will play the role of benefactor for Joe Biden's administration. I was reading an article in the Journal, I don't know, yesterday, I think, talking about how the economy could be a set of potholes for a Biden administration. And I read through it because I completely disagree with that. So I just wanted to know the journalist's opinion. And they really didn't connect the dots very well. So I always like to say slow news day when I see articles like that. And to me, the early cycle environment is going to be very favorable for the stock market. And the good news here is that these cyclical dynamics, they don't change very quickly. This is not going to move to a recession anytime soon. Even if you have some of these smart lockdowns, we feel like there's a lot of staying power, that the economy is definitely in rebound and recovery mode. But to be fair and balanced, I don't want to mislead you that everything is perfect. There's still a lot of work to be done. And I think of this chart here, looking at employment in the United States. You can see prior to the pandemic, we were at 157 million jobs, right? Actually gainfully employed people in the US. That was an all-time high, right, historically. And in a matter of 4 weeks, we lost 25 million of those jobs. We've just never seen anything like it, exceptionally exogenous to say the least. Now we've seen a nice V-shaped recovery, kind of hooking a right here a little bit. And then just last week, we got a nice number, another million jobs added for October, about 900,000, but I'll certainly round up. And unemployment rate is now down to 6.9 versus the 14.7 that we were at in April. It was 3.5 in February, so there is work to be done here. I think of this as the low-hanging fruit. A lot of this was low-hanging fruit. And if you go into the apple orchard, you've got to have to bring a ladder, right? Because these next 7 million jobs are going to be difficult to come by. And the timeline of which is going to be exceptionally dictated by the timeline for the vaccines, right? I think that makes a lot of sense. So when you look at timelines for other recessions, this actually helps us to shape our thinking for the next year or two in terms of employment. And by the way, the reason why employment is the numero uno statistic, it's very helpful because you get jobless claims every single week, so that's very timely. You also get the jobs number and unemployment every month, also very timely. But more importantly, employment is at the top, right? And of course, there's a trickle-down effect. So you can't spend money on goods and services unless you have a job, and you can't have a job, right, unless someone's going to hire you, and companies won't do well in that environment. So we look at employment and try to understand how long will it take until we get back to where we were before this pandemic. And you can see, again, the drop here. We've seen the nice tick up. And if you want to compare and contrast this to other recessions, what we're basically suggesting here is that the global financial crisis is not going to be the model to follow here, right? That was about 75 months after employment peaked in January of 2008. And it took, 6+ years for employment to get back to where it was, right? That was a very drawn out recession, to say the least. This one to us is going to be a bit shorter, probably look a bit more like some of these other recessions, even though the job loss was, multiples greater. And that's, again, because of social distancing. I mean, social distancing goes away or abates significantly, and that might take the summer. That might even take, maybe early 2022. Although I have a concert booked for the summer, so I'm really hoping for the summer. Kenny Chesney, right? It got canceled, but anyway, I don't want to digress. But you get the idea. I think a lot of us have plans for the summer. It is late August, so I'm gonna hedge my bet. The idea here is we feel like it's going to be sooner rather than later, but we just don't know. And the Fed doesn't know either, right? The central bank. So if you want more of an academic explanation here, we know that the Fed's forward guidance has said they're going to keep interest rates at the zero bound until 2023. And that's not just guesswork. They're saying 2023 because that's when they feel like it's going to take until jobs get back to where they were to that February of 2020 number. As you know, the Fed has a dual mandate. They want to get to full employment, and they can control that with interest rates. Simple way to do that is allow the company to borrow money. They can make payroll, and then they're more apt to hire somebody. That's why rates going down is obviously very stimulative to the jobs picture. And this is going to remain very, very accommodative. I think it was back in the summertime, might have even been the Jackson Hole Summit, where somebody asked the Fed chair, Jay Powell, when they thought about interest rate hikes. And of course, the response, and who knew that the Fed chair had such a personality, they're not even thinking of interest rate hikes. So I think that's pretty transparent that their toolkit will remain open for business. And as I mentioned, this is not just a domestic story. The Bank of England, the Bank of Japan, the European Central Bank, the People's Bank of China, the Bank of Australia, the Bank of Canada, keeps going. They're all in the same boat. Right? So no financial crisis, very different situation from the global financial crisis, right? It's actually what we use to define it. There's zero financial crisis right now. In fact, the banks are exceptionally well capitalized, and there's more money than you'd actually want to see. So good news here is the Fed continues to remain strong. On the fundamental side for the financial markets, right, what's the outlook here? Well, similar to the employment scenario, we know that the markets have done well, but they've done well in spite of fundamentals that remain challenged. And what you're looking at here on the left is the price to earnings multiple, right? So stock prices in the top, the earnings of those companies in the bottom. And you wouldn't be too surprised to see that this multiple is pretty stretched, right, relative to history. In fact, you have to go all the way back to the late 90s, right before the technology bust, to see multiples this rich. Now, I believe multiples are this rich because fundamentals have been significantly impaired, but yet stock prices are not reflecting the present day fundamentals. They're reflecting something into the future. And there's a big dose of artistic license being employed here, right? Meaning there's nothing scientific about this. It's not just 12 months, it could be 2 years. 2 years isn't all that long, actually, when you're doing this type of analysis. So the idea is that if you look at the right-hand side, earnings will come back sooner than the consensus probably believes. So 3 lines here, dark blue, this is real time, 2020 to 22. And the expectation is that if you look at this vertical line, this is the start of the recession. You can see the key here, right? So you get 100% of earnings right before the recession. And then the earnings go down as analysts start to say, well, a recession is not going to do so great for earnings. And what's it going to do? And you can see the dark blue line is the consensus that earnings went down, call it about 20%. And the expectation is that they'll come back here within 2 years and get back to where they were pre-pandemic. So pre-pandemic earnings were around 162, at least in 2019 they were. And the expectation is that it will take a couple of years to get right back to that number. I actually feel like, and by the way, note the disclosure here, that's June 25th, this number has come in way in. So we don't feel like it's 2 years. We feel like it's more like 18 months for earnings to make that round trip. Might even be sooner. In fact, you can see that today, the 12-month progression in earnings is around 162 as of today. So that's 12 months out. So in the next 12 months, we'll get back the earnings that we had in 2019. And if you just look at 2020, the third quarter, almost all companies have reported their earnings, and 86% of the S&P 500 surpassed the expectation for earnings. That's a big deal. And by the way, that 86% is a high watermark going back to the early 90s. We've never seen that percentage of companies actually beat what the analysts thought they would earn. And they beat it by 20%, which is usually 3.5% going back to 1994 is my exact time frame. So nearly 6 times greater on the earnings beat. And you might say, well, what gives? Well, what gives is people are still freaked out, but yet the economy remains very dynamic. And not to be too blasé about this, but let's think about the jobs that have been most adversely affected here. They're the restaurants, they're the hourly wage employees, right? Hospitality, leisure. A lot of these employees have hourly wages that are typically minimum wage or just a notch above. And with those individuals unemployed, the economy continues to grow, even in spite of that very acute unemployment. So that's why we feel like the earnings numbers are actually coming back much sooner than perhaps people feared. And then if I could be bold here into 2022, the bottom line earnings for the S&P could be close to $200. And if you're wondering, where's this guy getting this stuff from? We actually feel like human beings want to engage with other human beings, right? Call us crazy. But there is a pent-up demand quotient here. And we know that certain families have just completely isolated. And because they've isolated, they have the pent-up demand, right? They want to get back out there and do what they once did. And because they isolated, they have a lot of dry powder in the bank, right? Maybe they skipped that vacation in 2020. And even if it's a modest couple $1,000s, that money will go towards something into 2021 or 2022. So you could see a significant boost to economic growth as well as the financial market growth. And you have a Congress that will be a bit more conducive to it. And you have early cycle dynamics, which should provide a very powerful tailwind. So you can see that we are, let's just say, optimistic, right? I wouldn't even say cautiously, because we're not cautious. We are optimistic over the next year or two. The other component here is longer term. What's really relevant is the simple fact that the stock market remains in a long-term trend, and it's a good one, right? You actually see long-term trends over time. Secular bull markets on average 18 years up, secular bear markets on average 15 years down. We are now in a new secular bull market, started in 2013. This is where you will have higher highs and higher lows. And if you have a situation like a pandemic, right, where the market falls apart, look at this in the 50s in gray and the 80s in green. Of course, you had Black Monday here in green, right? That was in 87. And you had an Eisenhower recession in 57, 58. Market didn't like that. But yet, those were still in the midst of an upward long-term bull market. So by our lights, we still have at least an 8-year period, if not more, maybe into the early 2030s, of longer-term expansion of the stock market. And of course, if you're thinking of some type of goal in the next 10 years, I think you're probably smiling right now. And these are, again, long-term trends. We can see down days, even down months, but those are typically much more ephemeral, less protracted when you're in these very long-term up markets. So let me close by saying this, that we believe here at Fidelity, there's enough positivity in terms of good, strong catalysts that should allow us to stay invested and ensure that we're staying the course, right? You wouldn't want to miss out on these growth opportunities. But at the same time, we are highly cognizant of near-term volatility, right? What's the Senate look like in Georgia, even though I've suggested we don't think it really ultimately matters. People are worried, so there'll be near-term volatility. We will have a vaccine here, more than one, but how do you manufacture, distribute it? Who will take it? A lot of questions continue, but I'm not going to overthink it. It's going to be a good thing, not a bad thing. You want to stay balanced, right? You want your risk on, but your risk off. They can work together in a very effective strategy. This has always been the most effective and disciplined pathway forward, and today it remains so. So I'm going to pause here. I do have at least 7+ minutes for Q&A, and maybe I could even stay a couple minutes later.
All right. Well, listen, Brad, thanks a lot. I appreciate you going through all that. Again, if you want to ask a question, please just type them into the chat box. We'll read them out and move on. But I've got a couple while we're waiting for some questions to queue up, Brad. One thing that, again, kind of being more like election and markets and things that maybe can be somewhat disruptive, but a lot of talk, from a tax reform kind of, at least during the campaign, more progressive tax, we need to raise taxes, things like that. How do you see that kind of playing out? Is that something that's like early in the administration for Biden? Is that something, how do you guys see that at Fidelity? How does it impact portfolios?
Well, so again, 50-50 Senate, it's no strong conclusion that we'll even have any tax increases. And if we do have those tax increases, we would consider them to be diluted, meaning the ordinary income tax rate would most likely go back to 39.6. You may see corporate taxes go up, but instead of 28, you're thinking more 25. And one thing we're fairly certain on is in a diluted U.S. Senate, capital gains taxes most likely are off the table, which is a big deal because those were expected to go to ordinary income for $1 million and higher, right? Don't forget that was the caveat. So we feel like that could be the tax plan, and that tax plan most likely won't be a standalone tax plan, again, without 52 or 53 yays. It will most likely be embedded in some type of fiscal stimulus program. And you could see that, but again, you're going to have maybe a headwind from higher taxes, but certainly a tailwind from higher spending. So not to say it's a kind of muted or a moot point, but higher taxes will not happen without higher spending, and higher spending has proven to have a bigger bang for your buck, at least historically, meaning almost every time we've seen tax increases going to Harry S. Truman in 1950, the stock market hasn't blinked an eye. The stock market's usually up on that news, and I could always dive deeper there, but that's the bottom line.
Okay. Well, we've got a first question coming in. It's a really good one. Will 60-plus-year-old people retiring early because of COVID-19 dramatically speed up the drop in unemployment, as those jobs have been opened up earlier than they would have been? So again, you've got 7 million boomers will leave their jobs early. What are your thoughts on that?
Yeah, so it's a strong hypothetical. If you actually thought that a large number of people would retire early due to COVID, a lot of those individuals, and I don't want to generalize here, but based on the Bureau of Labor Statistics data that we know, they're not the ones affected by COVID. Now you might say, well, they're the ones most susceptible to the risk of disease. Yes, true point, but with a vaccine and better therapeutics, we feel like that risk is more optical than it is reality. And what I mean by that is, of the number of deaths due to COVID-19. Now, of course, we don't know if it's a singular death or whatnot, but neither here nor there. Nearly 50% of those deaths in this country have come from nursing homes, yet nursing homes only make up 4% of the country's population. So talk about a lopsided statistic.
Right.
And if you were to go to Canada or France or other parts of Europe, the number is more like 85% of deaths have come from long-term care facilities. So point we're making here is we don't feel like baby boomers who are still working, meaning they're not in nursing care facilities, are actually as susceptible to this virus as perhaps we think they are. And a vaccine and better therapeutics would really minimize the threat there. And even if you want to say 12 months out. So yeah, it's a good question. And the other component here is if we did see some early retirements, the unemployment rate wouldn't change much because the base of employees would change, right? So you would just have more people out of the workforce. And even if people replaced it, you'd have an unemployment rate that would remain effectively the same. Or slowly lower, but yes, the number of folks who are unemployed would be less, and that would bode well for consumption for sure.
Okay, and that again, you kind of bring up one other question for me, and we'll flip it over with employers realizing that their workforce can look a little differently now. How do you think will that accelerate or stagnate the employment rate? Realizing we can do more with less, or the same with less.
Yeah, probably the same with less. A lot of, do you think about the Latin term ceteris paribus? I use it probably too frequently, but
it just rolls off the tongue.
Yeah, I guess it does. And of course, what I mean there is, and if you hold everything else constant, what's that factor have a result in? Well, in theory, ceteris paribus makes sense, but in reality, right, empirically, it doesn't make sense at all because there's always these other factors. So to your point, right, will we actually see employers doing more with less or staying with less? It's a difficult one to answer. I think it even speaks to, will we all be working from home for the foreseeable future? And one could argue yes, but I'd actually argue no. You'll have more people getting back to work because we feel like it's really difficult to grow an industry, a business, anything when you're doing it virtually, right? Again, human beings, even the ones who are introverted, I don't think they're loving this Zoom stuff. But again, we could be wrong. It also speaks to real estate, right? Is real estate all going to go bust in the major population centers of the world? No. They're just going to either be repurposed, or the trend we've seen over the last several years has been less square footage per employee. Think of the WeWork model. Right, you had like 100 people in 1,000 square feet. Well, that's going to change, and now you could have a little bit of work from home, a little bit of work from office, and maybe your incremental square footage will go up per employee, just so people feel that they're not on top of another human being, because this is going to have some lasting effects, unfortunately.
Well, and that actually was our second question that came in, and you just answered it with, what would happen to the real estate? And again, I think we're also seeing the same thing where people are actually they're needing more real estate for the same number of people because they want to have more space and need more space.
That's right.
Now you could maybe see, to maybe counter that a little bit, you could have some kind of flexible, like in schools. I know that some areas of the country, some group of kids are coming like on Mondays and Wednesdays, and other kids are coming 2 other days, and they're leaving a day for cleaning, so you kind of have this rotation.
That's right.
Anything like that, do you think could impact the real estate market? Again, I think we agree more with you that it won't necessarily be as negative as we thought.
That's right. And let's face it too, right? There's a level of heterogeneity inherent in the real estate market, meaning not all real estate's created equal. Even office space, office space could be a technology company, could be a financial company, could be a healthcare company, and they're all going to have, different rates of growth going forward. So it's a difficult one to answer. You could even think of the retail REIT environment.
Right.
Yeah, we all know that big ugly malls are kind of dinosaurs, but there's not an apocalyptic environment going on there. I mean, Amazon, for example, is repurposing some of these big warehouse type malls for fulfillment centers. Right or wrong, don't like it, love it. That's actually pretty ingenious on behalf of Amazon, and it should help those local communities with jobs, with more tax revenue, and also avoiding some type of concrete jungle that has weeds growing out of it. So, to me, there's a lot of negativity out there in some, especially real estate. The dust hasn't settled there. And I'll be fair, social distancing lasts longer. That's going to be a bigger headwind for those entities.
Right.
But let's hope with this vaccine news that we're, closer to the end.
Well, and I think that was kind of a general consensus. Vaccine, or just, here's the vaccine. That would start to, we would start to kind of see that light, or the brighter light at the end of the tunnel. And hopefully that'll be the same with real estate, and some things take some more clarity. Another question just came in, just one word: inflation. So I'll expand upon that. With the Fed, again, you go back to Jackson Hole, where they made the I guess fundamental change in how they're looking at rates, and what they're more average versus basically taking spot rates. What do you see inflation? How do you see that impacting portfolios going forward?
Right. So I'll end on this one. So to me, inflation certainly would have been a greater issue if you've had a significant Democratic sweep, meaning the Democrats picked up 8 seats in the Senate, right? Which could happen in 2022. I mean, they could pick up a lot more seats. We shall see. But we're not going to get super significant spending plans here. At least we don't feel like we're going to. And the reason why inflation could have been more of an issue is if you spend a lot of money, that could dilute our dollar further, which makes that basket of goods and services even more expensive, right? The purchasing power of the currency goes down. So the basket of goods and services goes up, and voila, that's inflationary. Higher inflation, what you'd want to probably do to mitigate that would be to buy TIPS, right? Treasury inflation protection securities, to buy gold, and yes, maybe even real estate or other hard assets, right? Even commodities to a lesser extent. But we're not going to get super rampant hyperinflation because we're not going to get those big spending plans. Now, we do have a budget deficit that continues to burgeon. We have a debt level that continues to grow, and we have a trade deficit, obviously, that's been kind of perpetual since China has done their thing 20 years ago. That should be inflationary, but here's the rub. We've had a deficit, we've had a trade imbalance for a long time now, and we haven't had any inflation. So it's easy to think about the catalyst for inflation, but what about the catalyst for disinflation? Now, I didn't say deflation,
right?
Disinflation, a deceleration of inflation growth. That's clearly innovation, technology, demographic shifts, right? So people getting older, even that question you posed about people retiring, even if they're healthy and they're going out and spending money, a retired couple typically spends less than a gainfully employed couple. So that's disinflationary. So we actually feel like there's enough disinflationary trends that should be a counterforce against the inflationary trends. The long and short of it all is, don't expect inflation to be a major issue here in the very near future. And I would also tell you that on the dollar side of things, because the dollar is cheapening here, Joe Biden should be a weak dollar president. He's going to have better trade policies. He's going to have much more multilateral trade policies, might even remove some tariffs. That could bode poorly for the dollar if you're long the dollar. But if you're long international, if you're long companies that get more of their sales from overseas, think semiconductors, right? 65% of the sales overseas, that could actually bode very well. But we also feel like there's enough of a demand for the dollar, which might offset some of that depreciation, right? The US dollar, last time I checked, is still the world's reserve currency. So there should be a good bid for it.
Yeah, you would think. You would think. I'm sorry,
David, I apologize, but
you gotta go.
I'm 5 minutes late to another one. This has been great. I love the dialogue. If there are further questions, nothing's off the table. I'd be more than happy to jot up some notes and send it to David Coe and get it back to you. And I appreciate it.
We will. We'll keep the line open. You drop off, Brad. Go have fun at your next meeting. Restock your water. We appreciate your time, man. And we'll keep it open for another 10 minutes. See you, Brad. Have a good one.
All the best, everybody. Thank you again.
Yeah. And just, if you got any question, anything that sparked your interest, want to know more about, just go ahead and text that, or not text it, but chat it in the chat box. We'll, again, that international comment I thought was interesting. I think we're seeing some value there. David, I'll put you on the spot just briefly, but I know that you guys are seeing some pretty, some optimism, even though you've got, economies maybe internationally looking at shut down, but I think you guys, some optimism around international.
I mean, certainly a lot more interest over the past couple of months than we'd seen in the last couple of years.
Mm-hmm.
I think when it comes to international, the real key is focusing on specific companies rather than making a bet on broad markets. As an example, right now, what we've seen is a lot of the Asian economies, because of their, I would argue, draconian stance against fighting the virus and taking measures that, frankly, most of the Western world probably wouldn't have felt comfortable with. Because they took those measures, their economies are largely back open. The consumer is back, and life is continuing on. It's getting back to normal faster. So some of our international portfolio managers are looking at European companies that export largely to Asian consumers. So think luxury goods like LVMH, but even more consumer brands like Nestle, Heineken, that spirits companies. Trying to play on the strength of the Asian consumer through the companies that are regulated in a more understood economy or market like Europe.
Mm-hmm. Well, and again, you've got opportunities there, and I think you brought up something. And again, we have a lot of financial professionals on this call, and so you said something that hopefully gives us a little pep in our step as well. But you're talking about active over passive. So again, that value proposition of why you work with advisors, why you come up with plans, why you look at things, nothing static. You're always evolving, finding those opportunities and seeing how things go. So again, nothing like some market volatility to really kind of bear that out is a reason to have, some good advice, some good advisors working hard for you. I don't see, we just, again, and because we're kind of running out of time, but if anybody's got any other questions, and again, we really appreciate the Estate Planning Council, Chattanooga Estate Planning Council. It's great to have these guys on the call, so thank you. Don't forget to get your CE. I put that in the top of the chat box. So how you guys can get your CE, it's Thankful20, I think is what you reference. And then Robin should be able to get all that lined up for you so you get your CE credit. David, any other interesting things you got coming out of Fidelity that we need to know about?
Well, there's always something new, Dave. I've been with Fidelity 5 years, and it seems like every 6 months there's an additional offering. And I think, at the end of the day, what we're really trying to do as a company is, figure out better ways to partner with firms like Stonebridge and bring products that are relevant to your investors and client base. Better product, cheaper price, more efficient access to parts of the market that can help us all meet our retirement objectives. Broadly speaking, a lot of innovation in the ETF space that I think we'll all benefit from as consumers of products in the years ahead. But the message that Brad communicated today is I hear from every different group at Fidelity across the board. It's one of optimism, a lot of conviction that things are getting better, that recovery is going stronger than, frankly, we could have anticipated. And regardless of what side of the political aisle you're on, it's an environment that we're, frankly, in the near term, not overly concerned with. There's nothing that we saw from last week that would lead us, from an investment perspective, to say we really need to be concerned and pull money off the table. In fact, it's more of an opportunity to continue to invest, have confidence in the plan that you've put together, and on the margin, perhaps consider more international exposure if that's something that you're underweight, which many of our clients have been for the past couple of years, largely given those comments around the dollar. So, I think it's a good time to be an investor, and certainly an important time to be working with a firm like Stonebridge that's keeping an eye on all of these things as the markets continue to move.
Well, and again, and we appreciate that. Kind words. Thank you, David. And we appreciate you guys. It's, Eric and I, we have a lot of fun in our job. We're very passionate about the portfolios that we make, and we really enjoy working with, again, a lot of smart folks out there, and able to kind of make sense out of some things. So again, good stuff, timely. If anybody else, again, we're about 4 minutes or so. We can wrap up early if no other questions. But we certainly appreciate, had a great turnout again. And, you know, we do these, for those of you new to this, you know, about every month and a half or so, you know, we try to put something on that we think makes sense. Not always about investments. We've done some behavioral finance and, you know, behavioral studies. You know, we try to have a little fun with these as well. So again, thank you guys for attending. No other questions. We'll just shut it down. And David, appreciate you and appreciate your team, man. Thanks so much.
Well, thanks for including us. We really appreciate the time this afternoon.
All right, guys. Have a good one. See everybody.